Welcome. In this video, XCN is forming a pattern that will increase 3,000%. When is the pump? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. The fact that the price is currently sitting exactly on a support level is a highly critical situation in terms of technical analysis, because support levels represent areas where buyers concentrate, selling pressure weakens, and the probability of the price moving upward strengthens. Therefore, the price being right at this level is an important signal that can determine the direction of future price movements. Support levels are closely tied to investor psychology, as many traders see these levels as safe entry points, which naturally increases demand. As long as the price stays above support, confidence dominates the market. Investors begin to increase their positions with this confidence, and the likelihood of the price moving upward becomes stronger. That is why the idea that the price should bounce from support creates a positive expectation in technical analysis. When the price touches the support level, it often acts as a turning point for the market. This is because the decline up to that level usually triggers stronger buyer activity, especially if the support has been tested multiple times before, meaning the price has bounced from this zone in the past. It becomes even more significant in the eyes of investors. In such cases, the probability of a bounce from support is higher, both psychologically and technically. It is also known that large investors and institutions often open positions at support levels. That's why holding the line here and starting to move upward can be seen as evidence of strong buyer support coming into play. The fact that the price is right at this level and may respond upward reinforces investor confidence and strengthens the bullish scenario. At the same time, the price holding above support not only shows that buyers are stepping in, but also signals that sellers are starting to lose strength. While prices fall, sellers are in control, but once the support level is reached, their pressure weakens. If this breakdown of selling pressure occurs, sellers give up, buyers gain the upper hand, and this makes it easier for the price to bounce upward. A bounce from here could completely shift the psychological balance in the market. Traders who were expecting a continued downtrend may change their stance after such a bounce, abandon their bearish expectations, and start to think in terms of buying. This shift increases demand and contributes to a stronger upward movement. Bounces from support levels can also indicate either the continuation of an existing trend or the beginning of a new one. If the price is already in an uptrend and has pulled back to a support level, a bounce here signals that the trend is continuing in a healthy manner, strengthening bullish expectations. On the other hand, if the price has been in a downtrend and reacts upward from this support, this can mark the beginning of a trend reversal. Strong buying activity from support levels often foreshadow such changes and create highly profitable opportunities for investors. Therefore, the price being at support right now and the expectation of a bounce from here represents a critical turning point for future movements. The idea of a bounce from support is also a fundamental part of trading strategies. Many traders aim to buy near support and sell near resistance. This strategy is based on the expectation that the price will react upward from support. For this reason, when the price is sitting at support, many traders place buy orders there, which makes it easier for the price to bounce. Order accumulation takes place in the support zone, buyer strength increases, and this buildup pushes the price upward. A bounce here is not only a technical reaction, but also the result of buyers collectively entering the market. That's why bounces from support are often fast and strong. As long as the price remains above support, investor confidence grows because it shows that a solid base is forming in the market. Traders maintain their bullish outlook as long as the price doesn't fall below this level. If the price begins to bounce upward from support, this confidence strengthens even more and attracts new buyers into the market. This increases upward momentum. Especially for long-term investors, seeing the price hold its support is interpreted as a strong foundation, leading them to grow their positions. This rising demand can accelerate prices increases even further. A bounce from support also creates new momentum in the market. Bearish traders who see a strong reaction from support may begin closing their positions, further reducing selling pressure and making it easier for the price to rise. Meanwhile, buyers are stepping in, creating strong upward momentum. This momentum can drive the price up rapidly. In such a scenario, expectations shift quickly, confidence in the bullish trend strengthens, and the price can move to higher levels more easily. In light of all this, the fact that the price is currently at support and the idea that it should bounce from here draws a positive scenario in technical analysis. A bounce from support increases buyer confidence, weakens selling pressure, and lays the groundwork for either a new uptrend or the strengthening of the current one. That is why support levels are extremely important for investors, and the fact that the price is right there right now is seen as a major opportunity. If a strong bounce occurs, the price could reach much higher levels, not only in the short term, but also in the medium and long term. But we can't rely solely on support for analysis. So let's take a look at the other metrics as well. Stay tuned. The possibility of the price climbing back above the 200 EMA is one of the most critical scenarios closely followed by investors in technical analysis. This is because the 200 EMA is considered the most important moving average for determining the long-term trend in the market. Since many professional investors and institutions take this level into account, whether the price is above or below it reflects not only short-term fluctuations, but also the overall market direction. Therefore, if the price rises back above the 200 EMA, it strongly signals that buyers have regained control of the market and that a new rally may be on the horizon. Especially when the price has spent some time below this average, breaking back above it with a strong close is usually seen as an indication that the bullish trend has returned and often increases investors' appetite to buy. This in turn makes sharp upward movements easier as breaking through this psychological resistance level restores confidence in the market. Staying above the 200 EMA also prompts long-term investors to reassess their positions. For example, when the price is trading below the EMA, investors often either remain on the sidelines or act more cautiously. However, once the price moves back above it, many investors are drawn back into buying. This is because such a move is perceived as a strong signal that the long-term uptrend is intact, or at least that the correction has ended and a new bullish wave has begun. As a result, market activity tends to increase when the price breaks above the 200 EMA, with buy orders piling up and fueling upward momentum. This momentum often creates a chain reaction since, in addition to manual traders, algorithmic systems also factor these levels into their buy-side strategies. Thus, breaking and holding above the 200 EMA triggers shifts not only among individual investors, but also within automated trading systems. In such a scenario, the strength of the rally is often reflected in how quickly previous resistance levels are broken. When the price has long been under pressure, buyers wait for a breakout, and once it happens, they tend to move collectively, leading to rapid price increases in a short time. Moreover, holding above the 200 EMA provides not only a technical advantage, but also psychological reassurance. Investors often view this level as a threshold. Once breached, the path ahead is perceived as clearer, giving the price the motivation to rise more quickly. Since most market participants regard this moving average as a dividing line for trends, reclaiming it becomes a turning point. On the other hand, staying above the 200 EMA often coincides with technical patterns coming into play. For instance, as the price rises, higher lows and higher highs begin to form. This is one of the clearest indications that the uptrend is strengthening again. In this case, buyers take control while sellers step back, shifting the balance of power in favor of the bulls. This transformation accelerates the entry of trend-following investors who typically look for confirmation of trend direction. For them, closes above the 200 EMA are considered safe buy signals, bringing more liquidity into the market and supporting the price's upward momentum. The move above the 200 EMA can signal not just a short-term rise, but also a potential long-term trend reversal. Especially in bear markets when the price has spent a long time below this average, breaking upward sends a powerful message that the market may have left its bottom behind. This encourages investors to open not only short-term, but also long-term positions. As a result, the market doesn't just experience the sudden rally, but also the potential start of a sustained uptrend. In this process, investor behavior shifts. Fear gives way to confidence and positive sentiment spreads. The price's rise is thus supported not only by technical factors, but also by this psychological shift. Additionally, holding above the 200 EMA usually generates positive signals across higher timeframes as well. When daily or weekly charts begin to show closes above the EMA, long-term investors grow more convinced that a new trend is taking shape. This accelerates new capital inflows into the market and strengthens the foundation of the uptrend. During this rise, previous lows often turning to strong support levels. While the price staying below the EMA causes these areas to act as resistance, moving above it transforms them into support zones. This shift makes the rally more reliable. At this point, another factor investors watch closely is how the price reacts when it pulls back to the EMA. If the price tests this level and then bounces upward again, it indicates that the 200 EMA has turned into strong support. In such cases, each pullback becomes a new buying opportunity for investors. The longer the price maintains its hold above the 200 EMA, the stronger the confidence, and investors are more inclined to buy at this level. This cycle helps sustain the price's upward momentum.
The appearance of a W pattern on a financial chart, especially if the same formation has previously led to a very strong rally, creates an extremely positive and exciting scenario in investors' minds. The W pattern is considered one of the strongest indicators of a rebound from the bottom in technical analysis. This is because the structure shows that the price has tested a strong support zone twice, proving that sellers are weakening while buyers are increasingly taking control. The fact that the price first drops to a certain bottom, then recovers and rises slightly, pulls back again to the same zone or a nearby level, and finally makes a strong upward move is a sign that confidence is starting to return to the market. When investors see this structure, especially if they have witnessed the price make a massive surge after a similar W pattern in the past, they start to believe that the same scenario could repeat. This becomes an important source of motivation that can accelerate the price's rise. What stands out here is the price movement that happened before. The fact that the price previously showed an extraordinary increase of about 3,000% after a W pattern has left a very strong mark in investors' memories. In market psychology, the perception of history repeating itself holds an important place. Technical analysis itself is built on this logic, the belief that price patterns that emerged under similar conditions in the past can produce similar results in the future. For this reason, the formation of a new W pattern, especially when compared to the previous massive rally, creates much more hope and expectation. Many people in the market think that if the pattern once lifted the price by 3,000%, it could bring about a similar surge again. The strength of a pattern is influenced not only by its shape, but also by the market conditions in which it forms. If the market is currently trying to recover from a low point similar to the previous situation, most investors will assume that the price is once again preparing for a major rally. This expectation leads to a rapid increase in demand and strengthens buying pressure. As buying pressure grows, the upward movement of the price accelerates, which makes the confirmation of the W pattern even stronger. The breakout of the formation typically becomes certain when the price surpasses the middle peak, also called the neckline. When the price breaks this level with strong volume, confidence in the market multiplies and triggers a chain reaction of buying. The previous 3,000% rally is significant not only from a technical perspective, but also from a psychological one. Many market participants have etched this figure into their memory. For this reason, the price forming the same pattern again becomes a beacon of hope not only for those who understand technical analysis, but also for ordinary investors. Human nature dictates that those who missed a major opportunity in the past tend to act much faster and more boldly when a similar chance presents itself again. This further increases buying pressure and accelerates the rally. Another important point is that the W pattern symbolizes the market's transition from a bottoming phase. The price tests the same zone twice, proving that sellers have been exhausted. This creates a strong foundation for the start of an upward trend. If, just like before, a 3,000% increase seems possible after this formation, it means that the market is expecting a huge potential wave of buying. Large investors, funds, and whales also closely monitor such patterns because they provide the opportunity to open large volume positions with confidence. In other words, this scenario attracts not only small investors, but also big players. The fact that the W pattern is forming again now, therefore, is not just an ordinary technical development, but a massive signal of opportunity for the market's future. Especially after the previous 3,000% rally, the new formation raises the question of whether history will be rewritten. If the same scenario repeats, the price could gain extraordinary momentum and reach levels that seem almost unbelievable. Such moves not only create short-term profit opportunities, but also change the long-term perception of a given asset's value. Once the price makes such a leap, it attracts more investors worldwide, receives widespread media coverage, and draws in new buyers. At this point, investor expectations become extremely important. If a large group believes that the W pattern will once again deliver a 3,000% rally, this belief can turn into a self-fulfilling prophecy. In the market, expectations often matter more than reality. If people believe the price will rise, they buy more. As more buying occurs, the price rises further. As the price rises, more people get interested. This chain reaction creates an environment where a repeat of the previous massive rally becomes possible. In markets with high volatility, such as crypto, the effect of these patterns can be even more dramatic. Prices move much faster and much more sharply here. Gains of 3,000% are almost impossible in traditional markets, but in the crypto world, they are events that have happened before and are considered possible again. This makes the expectations around the W pattern even stronger. Investors naturally think, if it happened once, why shouldn't it happen again? In conclusion, the fact that the price previously surged 3,000% with a W pattern and is now forming the same structure again is an extraordinarily powerful signal for the market. This formation not only indicates the beginning of an uptrend from a technical perspective, but also boosts investor confidence from a psychological standpoint. If this scenario repeats, the doors to a massive rally could be opening up. When investor expectations, increased buying pressure, interest from major players, and the market's volatile structure come together, it would not be surprising for the price to gain very strong momentum once again. The 3,000% surge of the past serves as an example of what is possible, and if the same pattern is emerging again, the market could very well be on the verge of another explosion.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.